I'd be remiss if we did not start with the Federal Reserve. What is Goldman expecting from the Fed tomorrow?
So we're expecting a 25 basis point cut. We do, to your point earlier, think that it should be somewhat of a hawkish tone, however, in the presser. And the most important parts will be, the comments that are coming out of Jay Powell, in addition to where they see the forward dots and where we see some of the dissents, especially considering the composition changes within the Fed and some of the voting constituents.
It sounds a hawkish cut is a little weird, right? We kind of got one last year where it's like almost like a hold your nose type cut. It's a little bizarre.
I mean, they're clearly going to address the dual side of their mandate, and they're going to, allude to the fact that things are, both sides of the mandate are under pressure, which is why they're going to start the cutting process. But, let's be clear, inflation is still, at best, trending sideways. Now, you could argue that the structure and the composition of that inflation is in a better shape. But in no way, shape, or form are we close to the 2% target that they're looking to achieve.
Should they be cutting into an inflationary environment?
I think it's very difficult, if you really do have this dual mandate, to not start to cut when you see the weakness that we've seen in the labor market. Now, that being said, from the June SEP to now, actually, the spot data has materialized to what they've called for. So we're about, trending towards a 4.5% unemployment rate, core PCE around 3%, and they had marked in two cuts. So this is just starting the journey that they had already started to signal towards.
And the SEP is, I believe, Wall Street speak for the Statement of Economic Projections, where basically the Fed looks out. What do we think is going to happen? I imagine your clients, though, Alexandra, what they're going to say is, okay, well, everybody expects a Fed cut. So if we get the cut as expected, what does the market do? Because maybe a lot of the rally we've seen recently is because everybody knows they're going to cut.
Yeah, so when we're talking about the market, I think the bond market and the equity market will have a different response, and I'll get into that in a minute. But one of the things that, the bond market is expecting 6 cuts, and they're expecting them done in this linear fashion, and, it's hard to believe that everything's just going to materialize to look that way. When we do get the cut, it's going to be on what's the forward, what's the trajectory from here, and, do we end up having to push out one of the expected market 3 cuts into the following year, and should that, cause the curve to flatten out a little bit or not?
Does it matter? If they cut in December versus January, do we care?
Not really.
No, I don't think so.
No.
So what will be you referenced the 2 reactions. You got stocks over here, you got bonds over here. Mm-hmm. What are you expecting from each?
So on the bond side, assuming we get somewhat of a hawkish tone, but still the proceeding of cuts, we're expecting the bond market to trade about sideways. There is still.
I thought it was supposed to, yields are supposed to go down if they cut rates.
But that's already been priced. We've got 6 cuts priced in from here.
And in Europe, they were cutting rates, and guess what? Bond yields went up.
And then they recently stopped, right? So the bond market has flattened out in Europe. But on the equity side, importantly, the equity market is trading to different themes. And I think you and I had actually chatted about, $500 billion worth of global CapEx as it relates to AI. We just had a new entrant into the $1 trillion club, one that actually wasn't expected. And I think when you look at, some of the speculative growth that's been considered as it relates to AI, we just got a proof statement that speculative growth is actually real growth, and it's, projecting out multiple years from here. So we still see plenty of room in the AI story, but more holistically, when you get cuts that are non-recessionary cuts, typically the market goes up 15% over the next 12 months. And so
repeat that, because that sounds important.
So when you go into a non-recessionary cutting cycle, the hit rate is, by the way, 100 times out of the last times this has happened. Even when stocks are at all-time highs, you end up having a plus 15% return on average over the next 12 months. So that's pretty bullish.
Well, 100% of the time is, I think, all the time, right? I mean, I'm not a math whiz, but that seems like a lot. So basically the idea is we get a cut tomorrow. No matter what people think, history says, and by the way, what's that disclaimer? History is no guarantee of future results, whatever it is. So
yes.
It may not happen, but 100% or a lot of the time in the past, the markets continue to go higher.
As long as it's not a recession, yes.
And we don't think we're in a recession.
No, honestly, one of the things that's been really hard for the market to digest has been these, cross currents that are coming from an economy that we think is actually adapting and not unraveling.
Yeah.
And that adapting is coming from all of these structural themes.
Very quickly,
Yeah.
What's more important? I know the Feds, we got the meeting tomorrow. It's at 2 p.m. It's where the show starts. Got to ramp up the fervor. But is AI spending more important to the market than the Federal Reserve, or no?
I wouldn't say it's a zero-sum game. I think that both are equally important. And in particular, when you're looking at some of the winners and losers that have been happening and the income dispersion that you're seeing with consumption, rate cuts are really important. They're important for people who have floating rate debt. They're important for corporates. It's the lifeblood of the economy. It's going to continue to be important. So is the AI story.
They're also important to presidents because it doesn't matter what your political party is, you probably want rates lower than higher. Alexandra Wilson-Elizondo, really appreciate you coming on set.
Thanks.
Thank you.
Me.
Take care.